Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money in 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Well, good morning and welcome to Consider This. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. Angie, in these interesting times of being trapped at home, I found myself going back in history. Talking on Zoom. We had 2 Zoom meetings actually 3 Zoom meetings for Easter Sunday. I don't know about you. But there was a microwave that my grandmother had. So I remember our first microwave that I got. I was in junior high school. We were in whopping 8th grade. And my grandmother passed away, and Barb and I inherited her microwave, and it was this big thing. Now, I was an ex-football player, power lifter, and I remember carrying this microwave in, and I mean, it took everything I had to carry. This was a chunk, right?
Yeah.
This was a heavy...
Kind of like the old computers when they first came out.
But in my mind, this thing cost thousands of dollars, right? And so I put the microwave up in the corner, and it finally died, and I was so depressed. I mean, it made it for 2 or 3 years. We went without a microwave for 2 or 3 years because Joe doesn't shop. Right, in my mind, what is there, and things don't change, that wasn't my universe. Financial planning was my universe. I knew the tax code changed, I knew investments changed, but I didn't know microwaves changed, right? So we finally take it to Brockula, a TV place and microwave place here in Anderson, and they called back 2 weeks later and said, Mr. Clark, we can repair your microwave, but you should just really go to JCPenney's or Sears and buy another one because they are much cheaper than what it will cost to fix it. I go, what? No way, right? and that's exactly what we did. The price of buying a new, much cheaper, much lighter, much more productive microwave was about half the cost of what it was going to cost to repair that microwave. So why do I bring this up in this conversation early in the morning? Well, one of the things when we talk about the fiduciary focus here on the radio show, we're talking about risk and volatility, fees and expenses, taxes today and tomorrow, and real return. And one of the things that we know are people make decisions today because of things they believe to be true in the past, like I did with a microwave, right? And I will tell you the same thing with the printer. Angie's talking about needing to print things off because we're self-quarantined and everything with COVID. And the reality is buying a printer anymore is cheap, and the toner is cheap. The printer you probably have at home costs much, much more than what it costs to go today. So for goodness sakes, go buy a printer.
I have a printer. The printer's not bad. It's those darn ink cartridges.
I think it's all changed. Hey, you're listening to Consider This Program. Joe Clark, Angie Kinzer. We're going to have a lot of fun. 800-928-4001. Give Angie a call for your next steps meeting. We'll take a break. We'll be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Have you ever wondered if you should do a Roth conversion? Have you ever wondered if now is the right time? Well, we're going to break that down for you on Consider This program this week. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. So Angie's got a whole litany of questions
That's
that
right.
she has put together for Roth conversions. Is one of those what a Roth conversion is, Angie, or should I start there?
You can start there.
So a Roth conversion is when I take money out of an IRA or a 401k account that I've already got tax deferred, meaning I've not paid any taxes on the money went in or on the growth, and I'm going to do for a tax penalty free but still taxable event. I'm going to take some of that money right now this year and convert it from an IRA to a Roth IRA or a Roth 401k so that I never have to pay taxes on that money or the growth on that money ever again.
So is it a good time to do a conversion when the market's down?
If you believe the market is down. Now remember, one of those things you always have to start with, Angie, in a marketplace is where did it come from? Was the market too high before it fell? Right? Just because something fell 50% doesn't mean it shouldn't have fallen 50%. So you have to be determined. You have to feel that the market is truly low, not artificially low or artificially high. And if that's the case, then yes, it would be a good time to do the conversion if you believe that it's low. Okay. And you want to do a conversion. It made sense for you. Remember, on a Roth conversion, Angie, they're always right for the beneficiary.
Yes.
They're not always right for the person who does it.
So are the taxes based on the value of the IRA, currently or at the time of the conversion?
Time of the conversion.
Okay.
Right. So in the old days, we used to be able to reconvert. Can't do that anymore. The taxation is based on the amount you converted the day you did the conversion.
Do you think that taxes are at the lowest we'll see? What do you expect to happen when the
federal
sun sets?
Judge out of Philadelphia or Boston, I can't remember which, about 7 or 8 years ago, said that they could put me in jail if I ever said that tax rates couldn't go lower. You don't want to argue with a federal judge, so I won't go there. I will tell you historically, our tax rates right now are as low as they have gone. And in my estimation, in my personal position and situation, I will tell you I believe my tax rate will go up over time as opposed to decline over time. You have to make that call for you. I can't tell you per a federal judge. But you can use common sense. We have the baby boom retiring. We know what our deficit is. And we just added a little over $4 trillion in a federal stimulus package to get through the COVID virus.
So in essence, you are reporting more income on your taxes that year. But is it best to pay those fees or that extra tax with non-IRA money?
You have to. I've yet to be able to do a mathematical workup where it made sense to pull money out of an IRA and use part of the money that you pulled out of the IRA to pay the taxes on the IRA to do the Roth conversion. That's just going a little bit overboard. So if you do not have the available cash, the access to cash, then you shouldn't do the conversion. I will tell you this year, because of the economic uncertainties and the interruption, people who have a lower earning amount, lower income amount, or people who have variable income because of the coronavirus, this may be an ideal time to look at doing those kind of shifts for the conversions. The ability to borrow money out of a 401k, for instance. You can borrow up to $100,000. You've got 3 years to pay it back. You don't have, to be able to get it back in. I guess it's 2 years to get it back in, 3 years if you're going to pull it out and pay the taxes on it. In theory, there's some things you could do there. And this is why we sit down in our next steps meeting and come up with some unique strategies based on your individual situation. So if you want to know more about your next steps, you can call Angie at 800-928-4001. We will, in a 90-minute meeting, tell you what you should consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you. But we'll give you some ideas to walk out of that meeting. And we're doing those electronically now. I saw something on our website that said we're having phone meetings. We're not having phone meetings. We're having digital meetings. Right, we're face to face, eyeball to eyeball. There's a huge. We can do a phone, but I would always prefer to have you in front of me. This social distancing is not good for me. But at least on Zoom, we're getting closer.
And some people think that Zoom, or you hear something that you've never done before, and you think that's going to be really hard. We also had a Zoom meeting for family Easter, and if my family can get on Zoom, anyone can. So it's very easy.
There are so many jokes I could make. I will just leave alone.
Fine.
Angie, but, anyhow. Next question.
Is there a time when a conversion is not a good idea?
Yeah, if you believe your tax rate is going to fall in the future, it would make no sense to do a conversion if you believed your income was dramatically higher while you worked and your standard of living, right? Remember when you go to retire, Angie, a lot of the stuff online says you're going to retire. You need to have 70% of your income to retire. We think that's bogus. That's hokey pokey garbage, right? You need 100% of your standard of living. Well, we truly have people who make $200,000 a year that we take care of that live on $30,000 a year or $40,000 a year, right? They've always lived very much within their means. So if there is a way, because of the way that you saved, the strategy you deployed, if there's a way you're going to retire at a lower standard of living, or at a standard of living that has a lower tax rate attached to it, rather, then the Roth conversion may not make a lot of sense for you. If you got a lot of health issues where you may have a big healthcare cost issue in 1 year where you actually can go back and itemize, then it may be something you want to consider. Ideally, you want a third, a third, and a third. So Barb's plan and my wife and I's objective is to have a third of our money that is tax deferred, a third of our money that is as after tax, and a third of our money that is in Roth money. Now, when you're a business owner, and we've been very, very blessed, there's no way for my tax deferred and my Roth money to keep up with the value of the businesses. So that's where all of our charitable gifting will come from, is the side outside of the IRAs, the side outside of the 401k and the Roth, right? But it's, each his own, each has a strategy, but you want to build that tax diversification.
Okay. I know that clear back 8 years ago when I started here, you've always been
a long time ago.
You've always been a self-confirmed tax junkie. And back then we were doing recharacterizations as a strategy.
Yes.
And that changed. Do you see, is it always possible that somewhere down the road we could have something else like that come up?
They will always create things in the tax code that people will miss because it takes a few years for things to leak out into the system. Whether or not we'll ever have anything as special as the Roth recharacterization that so many people missed.
But didn't you find that out long before it actually took?
We did. We found out in 2007. It didn't start till 2010. We were given a 3-year notice. And if I see that coming again, then we will take care of our families again like we did. But we were able to create literally over $40 million worth of Roth money that'll never be taxed, by using the Roth recharacterization rules that were changed in 2018, at the end of 2017, effective in 18. And I'm sorry people missed it. I did everything I could to tell you, and I will continue to tell you the next thing that we find.
Well, real quickly here, we're talking about conversions here, but there's also contributions.
Yeah.
What's a quick difference?
A contribution is the amount of money that you put in based on earned income this year. You have to qualify, meaning your income has to be low enough and yet have enough money to be able to qualify. You can put in money for you and your spouse if you're married filing jointly. That's a contribution. Conversions have no income limitation. So you can be any age and you can have zero earned income and still do a conversion as long as you can afford the taxes. Great segment, Angie. Great questions. You can reach Angie at 800-928-4001. Don't forget to call her. Get signed up for a Next Steps meeting. You'll find out exactly what you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, things we'll do for you at the Financial Enhancement Group. 800-928-4001. We'll take a break and be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or or yourlifeafterwork.com. Now back to Consider This Program with Joe Clark.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
I'm Angie Kinzer.
We are talking about stock swapping and upgrades. So that's a mouthful.
Sounds
a
foreign
whole
to me.
a whole lot of jokes that could come out of there that probably would not be appropriate in any way, shape, or form.
No.
So I will. I'm just going to let you ask questions since you don't know what I'm talking about.
Oh, well, I mean, what triggers a stock upgrade?
So think about any upgrade, right? You're trading in your car to get a nicer car. You're trading in your house to get a bigger house. You're trading in anything to get something better. That's an upgrade, right? And what happens in a period of economic uncertainty, that's the thing that stock markets hate the least, is uncertainty. They want to know what's going on, right? So when you have economic disruption or uncertainty, you have price dislocation. And prices fall for different reasons. Now, I've talked about on the show before, I've talked about on our Financial Enhancement group page, the Financial Tidbits, which you guys are welcome to as radio listeners to get signed up for. We do videos there about once a week to try to explain to people what's going on. Again, that's Financial Enhancement Group, Financial Tidbits. But what happens is stocks go down in value or up in value for one of three reasons. Right? So at first you have people who are making what we call purposeful trades. Now, the reason you would buy or sell a stock, Angie, is different than I would buy and sell it. So let's use our personal lives, because I put mine out on the radio, so I might as well put yours out on the radio,
Fine.
right? I have no desire to own a rental home that I am going to try to flip because I'm going to go hang drywall, paint, sand, mow, any of that.
But if you enjoy doing those things.
Exactly, and you do, and I
do.
don't, right? So purposeful trading for me is driving by that place that is for sale, and for you, it's buying that place that's for sale, right?
Okay.
If somebody in my family died and I inherited, I would purposely sell that junk to you, right? And you would purposely buy it as a cherished item, right?
Okay.
So that's purposeful trading, and that happens every day in the stock market, right? When things get rocky, and you'd have to say we're at a rocky period of time right now. When things get rocky, you have painful trading, and that's usually trading that happens when people have to do it, right? You have to gather cash because the bank has said, Angie, your line of credit is being called in, and the other 3 homes that you have, you need money for, and you're going to have to sell this one to get it. You're forced to sell, right? That's purposeful trading. And then think Shark Tank. There's Mr. Wonderful and Mark Cuban and right,
Yeah.
Lori. They're all kind of swimming around waiting for somebody that has to sell, right? Somebody who needs capital, who needs cash. That's purposeful trading. Or that's panic trading. Or pardon me. Good Lord, we have purposeful trading, and then we've got problem trading, which is where we are on the Shark Tank, where we are with Angie. And then you've got panic trading, and that's what happened about 2 or 3 weeks ago in the market. When you had a period of capitulation where people flat out panicked. They didn't care what they owned. They didn't care what the company did. They didn't care about the earnings. They just said, get me out.
Right.
And then that's when the big sharks come in. That's when the great whites come in and the Warren Buffetts. And, you watched a lot of the famous traders who buy at the bottoms come in and start to not just nibble, but sort of gobble about 2 weeks ago. Now, that doesn't mean that I'm telling you to do that. That's not my endorsement of saying we're at the bottom. Please don't take it that way. But that's what we saw, and that's what we witnessed. So you've got purposeful, problematic, and then panic, right?
Well, and I know there's always like the analyst predictions. Are those why are you looking at me like that?
You see, this is why we're going to video the show, because you cannot see the eyebrows, the coffee cup delayed in the air when I looked at her when she said, the analyst. Okay,
All
go
right,
ahead.
Moving on. What does hold to buy mean?
Buy and hold is what it should have
Okay.
said. You probably, you're not dyslexic. You work with 2 of us that are. Buy and hold is the old strategy that you buy a company because you believe the company is going to be worth a whole lot more later on. And regardless of what happens in economic uncertainty and in market corrections, you don't sell the stock, right? You buy and hold Coca-Cola, you buy and hold Budweiser, and now Ambev, you buy and hold those companies. That's the argument that is behind it, right? Now, it's not one that we necessarily buy into. What I know, and I certainly don't mean this offensively, I told my team never to say this to your face, and here I'm going to go.
Okay.
I don't understand why it's so offensive. We take care of more than 1,000 people, 1,000 families at the Financial Enhancement Group in more than 30 states. And what I fully recognize is that most of them did not want to buy a certain percentage of Coca-Cola, a certain percentage of Intel, a certain percentage of Microsoft. They are, and what most of us are what we would consider sophisticated savers. They know putting the money in a bank, especially at a 1% interest rate or lower, is not the way to protect yourself from inflation over a financial journey, right? They come to see us because they want to be able to build value in their nest egg, and they're what I call sophisticated savers. The reason the money's here and not a bank is because they believe over time we will provide a greater value for the fee that we're paid. And, fortunately, God has blessed us the last 22 years through the tech wreck, through the Grand Recession in 08 and 09, and through what we're living through now. We have proven our value, and people have found it, and that's why they pay us.
Well, does Financial Enhancement Group have a process to try to find stocks like before they upgrade?
No, that's not part of our game. So there are people that are out there. Again, when we get into that purposeful trading, there are people who have different things that are out there always searching for home runs. They want to be able to say, "Wow, look I made 30% in a day or in 2 weeks or whatever." That's not who we are. We try to get on base, score runs, win games.
And we have certain processes for the companies that we own.
Yes, and the value, the way we assess value is a threefold thing. My job is to be responsible of what we call the narrative. I look at the big picture, the demographics, what's going on in the economic landscape of the Brexit, of the OPEC battle between Saudi Arabia and Russia and Putin, what's going on with the coronavirus. That's kind of my gig. Adam is our chief investment strategist, and his responsibility as a CFA, one of those analysts that you talk about. His job is to figure out what things are truly worth from a book value standpoint and what's a fair price to pay for them. And then Andrew Thrasher is our chartered market technician. His job is to look at it and say, based on what that stock is doing relative to all the others, how is it performing? We put the three together, and that's what builds the basis of our portfolio, if you will. Right? So there's always a process. It's not a one person going, here's a neat idea, let's go put money here.
I'm curious too, when a company or stock is upgraded, how does it impact that company itself?
Well, so there are people who follow some of those analysts. So if you've got somebody who is an analyst who upgrades a particular stock and says, here's what we think the new price point is, there are people who will chase it because they follow that analyst and it'll drive it up. Here, what I'm talking about, though, is for you individually. I'm not talking about an analyst upgrade. I'm talking about you've got Pepsi and you think Coca-Cola's got a better product, or you think Coca-Cola's better valuation, and so it's selling Pepsi, buying Coke. It's and I'm not saying that at all. It's you think that Indian has a better motorcycle than Harley and a better business model. It's you selling Harley and buying Indian. That's the upgrade. When you have dislocation, look at your portfolio, see if there are changes that you ought to make. Or you can come to the Financial Enhancement Group and have a next steps meeting. Give Angie a call at 800-928-4001. We're happy to talk to you. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
You know, the idea of harvesting sounds good. The idea of capital loss harvesting, that doesn't sound so exciting at all. What in the world is that? What should you do about it? Hi, my name's Joe Clark. I'm the host of Consider This Program.
And I'm Angie Kinzer.
We're happy to have you along. So, Angie, what do you suppose a capital loss is?
When you didn't make money on
Okay, you didn't
capital.
you didn't make money. So are we talking about an IRA?
No.
Nope. It's not an IRA at all. Once money goes into the black box of an IRA or a 401k, it doesn't matter what it went into, right?
Right.
So we're talking about a retail account. It's money that's after tax. So you've put in capital, and now you didn't make money is what you said.
Right.
So
So
that's
you
not-
actually lost.
That's not entirely true, because there are people who will have this adage that you didn't lose money until you sold. Now, we are not people who will tell you that that is the case. Because every dollar that you have, you get a vote, you get a revote today. Is there a better place for it to be used, right? So the idea of having money in stock and selling out of stock and going to cash is one thing. The idea of having stock, selling a stock today and buying another stock, whole nother story, right? Whole nother story. And that's more of what we do, as we talked about in the last segment of upgrading, is repositioning that capital for a greater opportunity with less risk, right? That's where it is. So a capital loss is, we've got $100 we've already paid taxes on. And I don't want you guys to think this. This is why we're going to do the show on video. I don't want you to think I have very expensive coffee cups, but I always talk about my $100 coffee cup, which I don't have a $100 coffee cup. If I had a $100 coffee cup, I'm sure my grandfather would come back and beat me. So I have this coffee cup, Angie,
Okay.
and we're going to pretend like it cost us $100,
Mm-hmm.
right? So I paid for that after tax. So the terminology that we use is that is my cost basis,
Right.
right? I paid $100 for it. Now, all of a sudden, and think about our premise, right, that there's three reasons to trade. There's purposeful trading, there's problematic trading, and there's panic trading, right? So I purposely paid $100 for this coffee cup for some unknown reason. It doesn't have to make sense to you.
Right.
It doesn't have to make sense to my wife, my mother, my grandfather. It doesn't have to make sense. To me, it made sense. I traded my Benjamin Franklin for this coffee cup, okay? Now, all of a sudden, something has happened in my life, right? One of my kids is having a problem because of the virus, and they've been dislocated from work, and they need money,
Okay.
right? And all of a sudden, Angie, because Angie can be like this, Angie comes up and goes, Joe, I've really liked that coffee cup, but it's not worth near what you thought it was, right? I'm going to give you $60 for the coffee cup, and I'm going to say a few nice or not so nice words to Angie and tell her no. And Angie's going to giggle, and she's going to come back the next week when things are even worse, and she's going to go, I'll give you $50 for the coffee cup. So I take her $50, grudgingly so, call her names. She's no longer getting a Christmas card or a bonus. She needs to keep that in mind. And she gives me her $50. I give her my coffee cup. I now have a recognized loss. I actually lost money, right? If you offered me $50 or $60 for the coffee cup and I didn't sell it, right? I didn't lose any money in theory. Right now, this is not me telling you if you didn't sell, you didn't lose, because that's not entirely an accurate statement there. You should not just hold your eyes shut and hold on to things just because you owned them yesterday. We've talked about that a lot on this radio show. But I now have a $50 capital loss. And so what happens in a stock portfolio is I'm able to look every day to see what people are willing to pay me for my stocks. And again, this is not an IRA, and it's not a 401k.
Mm-mm.
This is other stuff. And I'm able to look at it and go, okay, here's a stock. Here's this coffee cup that happens to have the name of a bank on it. And here's this coffee cup over here that has the name of another bank on it. And I really don't care which of them I have. They're pretty similar. They're both going to keep my coffee warm, right? They're both the same size tumbler. They just have different logos,
Yeah.
right? I'm going to sell this one that's at a loss so that I have a $50 loss. I'm going to take that $50 and I'm going to buy this other coffee cup, right? Now, why do I do that? Well, you don't want to be trapped in portfolios where you cannot make decisions, right? So we talk about this on one of our checklists that you can get from Angie at 800-928-4001, where we talk about turning lemons into lemonade. And I don't want to get stuck in a situation where I can't sell positions, where I can't sell stocks because the taxation, the capital gain is too great. And that's what we saw happen to people in 2018. It's what we saw happen to people in 2007. It's what I saw happen to people in 2000, January and February before the tech crack in 2000. I've done this for a long time, Angie, right? You want to build up capital losses when you can. On top of that, I can book $3,000 worth of capital losses a year, even against gains. So if I have a $100,000 capital gain this year, and I have a $120,000 capital loss because of stuff that I intentionally sold and didn't go to cash. This is not panic selling. This is purposeful trading,
Right.
where I reallocated the money to other positions that were similar or what I thought was an upgrade. Right now, I've got that $120,000 worth of losses. I've got $100,000 worth of long-term capital gains. The losses go against the gains, so I have no taxation there at all, and I can use another $3,000. So let's say your tax rate's at 20%, Angie. There really is no 20%, so we'll call it 22, but I'm going to use 20% as math. You're in the 20% bracket, and I get a $3,000 loss. That means I'm going to put $600 into your billfold this year. Cash money that you can take home, you can use for Christmas, you can use for vacation, you can use for whatever, because we were proactively harvesting losses as opposed to sitting on our thumb saying, well, I know the price will come back, which is nothing more than ego-driven, right? It's trying to prove your point. We don't need to prove points at the Financial Enhancement Group. We need to protect nest eggs. That's our job. We help produce financial regrets.
Well, are you allowed to buy an asset and sell it solely for tax purposes and then just go out and replace it?
So the rule is on a capital gain, if I sell something that's a long-term capital gain or a short or a gain, that gain is recognized immediately, right? If I sell something at a loss, I have to wait 30 days to buy back that identical asset. And again, we're not talking about IRAs and 401ks here, right? So if I missed this, I mean, you had the coffee cup and you were bringing it to the radio show and you were hanging out in front of me and I was missing my cup and it was only 25 days and I bought it back, I would not be able to take the capital loss. I'd have what's called a readjusted basis. On the other hand, if I bought the other cup, there is no rule. So it's a substantially equal or identical asset is the way the tax code works. I can't buy that back within 30 days if I sell something for a loss. But in the world of exchange-traded funds and the equity world that's out there, it is very difficult for me not to be able to replace an asset, to be able to capture a loss, and be able to repurpose it 30 days later with a similar asset. That's true of almost all stocks, almost all exchange-traded funds. It's just the way that the world works.
So is that strategy mainly to limit recognition on a short or long term?
I want to make sure that I'm able to take advantage of the loss, to be able to harvest it, to be able to capture it, so that I can be able to reuse it in the future. So here's the deal. What we're talking about in this segment is a tax strategy. We're in chaotic times, folks. There's no way around it. I can't tell you how this is going to shake out. I really, really, really can't. All I can tell you is that we need to deploy the best strategies that we can, and to ignore tax planning would be a mistake. So call Angie, 800-928-4001. Get signed up for a Next Steps meeting. We'll tell you things you need to consider today, things to consider in the future, and if we choose to partner together, things that FEG will do for you. 800-928-4001.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
There are different strategies, different things you can do to be able to use the value of assets that you already own. And what you want to do is to give yourself the opportunity to be able to be liquid when you need to be. Liquid means converting to assets that are spendable today. Hi, I'm Joe Clark, the host of Consider This program.
And I'm Angie Kinzer.
And Angie tells me, not by my own choosing, that we're going to talk about home equity lines of credit.
Yes.
All right. You get the questions. I get the answers. Well, hopefully we can come up together. And you actually, Angie's owned more houses than I have, so I should leave you this. Let me ask you the questions.
Oh, no.
All right.
Well, I know, for one thing, we need to make sure that people know there is a difference between an equity line of credit and a home equity loan.
Okay.
I mean, a home equity loan, you get a fixed term with a fixed rate. You set it up for 15 years or 3 years or 7 years and pay it off. You can not borrow any more against it. But a line of credit is not on a fixed rate. It's somehow tied to the prime rate, usually prime plus 2. And they
Look
will,
at you go, girl.
Yes, they will come out and evaluate your home. And then normally
Evaluating mean appraising.
appraise your home minus what you already owe on your first mortgage. And generally they're going to give you anywhere between 70, maybe 80% of the value of your home.
So JP Morgan announced today, today being, what is it, April 13th?
Yes.
I think it is, the day of the recording, that you now have to have 20% down to buy a home. Now, I'm going to find it shocking that they stick with that, that you have to have 20% down. They don't want to loan.
It's usually been that way for conventional loans, but
no. Or they would do yes, for conventional. That's right.
Yeah, but then you go FHA or
right. You have the others. You can do PM, but that's
you could go 3%
the initial.
down.
We're getting sidetracked. That's
Okay.
the initial purchase. My point is, we are in changing times, so keep in mind what Angie said. There's loans. That means you're using the equity value inside of your home, typically your your typical residence. Or your primary residence, I should say, fixed payment, and you're going to pay it back over a given period of time, just like you would a first mortgage on a home. The second is a line of credit, where you can, what we call put and take. You can put money in, you can take money out, right, and kind of go from there.
Well, and it used to be scary to take a line of credit knowing it was tied to the prime because you didn't know for sure what the interest rates were going to do.
So since you left the mortgage interest, young lady, which was the mortgage world, which was, what, 10, 15 years ago?
Yes.
Yeah. Now more often we use this thing called LIBOR, which is the London Interbank Offering Rate. And most of the lines of credit are attached to LIBOR, not prime. And it's because it's more steady. Though there was a big hullabaloo a few years ago where people went to prison for fixing the LIBOR rate. It's the world of scandal. What are you going to do? What are you going to do? All right, so go ahead and ask the questions, and maybe between the two of us, we'll be able to have an answer.
Okay. With interest rates down and the housing market still up, is it a good time to take a home equity loan?
As a fiduciary, let's go the other way. As a salesperson, if I was a securities broker, to tell you to do that is absolutely immoral, unethical, and I should be hogtied and strapped, right? As a fiduciary, my job is to treat your money as if it were my money and we were in the same situation, right? So looking at it April 13th with the S&P 500 rallying 20%, the answer is I would not be taking money out of my house today to go buy into this market. I will tell you, if I could have access to the equity in my house, 3 weeks ago, what I deemed to be the low, came close to putting it in print, didn't put it in print this time for the first time in the last three market lows. I still think what you saw March 9th, March 10th is going to wind up being a good buying opportunity. I would have pulled money out then out of my house, though I would have never told somebody else to do that.
No.
And keep in mind, I'm 53. I've got more years to work, and I've got a big company that I get to have support me. So,
and you're talking about cash out to where you're going to use it for something else.
Oh, it would have gone straight to investments. I mean, I would have used money in one investment that I thought had retained value to buy assets that I thought would have been dislocated. I would go to take advantage of people at that point in time that were in problematic or panic sales. Is the only reason I would ever do that. So I could never encourage you to do that. In fact, we had one of my dearest friends and his wife called and asked me to come do that, and I sent him a 2-page email about why this was a bad idea, and fortunately they changed their mind, did not pull the money out of their home equity line, and this was the end of February. It would have been a crushing blow to their financial future if they would have done it.
Now, if you use your home equity line in another way, not to go out and buy stocks, things like that, like I use one because, I have project homes. Credit card interest rates are a lot higher than a line of credit would be that uses my home for collateral. So if I know for sure that I'm going to have a project home for 3 to 4 months and then I'm going to sell it and I can pay the line down and pay it off, it works better for me than using credit cards.
Sure. And it's very similar to people who use what's called margin on their stocks. The difference is rarely, maybe in 2008 and 9, but rarely do you see stocks or homes depreciate in value as quickly as stocks can. Right. So in one of the things that we think is going on in the marketplace right now is what's called a short squeeze. Right. So believe it or not, I can't. Though it would be fun if I could drive by one of your houses and go, I think Angie's wrong. I want to sell that house. Well, I don't own that house, so I can't sell that house, right? But if I could sell that house and find somebody else to buy it for a lower price, then I would be able to profit the difference between what you thought it was worth and what they thought it was worth, right? Margin or selling stock short is essentially the same concept. You see my $100 coffee cup that I like to talk about, and you think it's only worth $50. And so you sell it at $100. Knowing that you're going to have to pay interest, knowing that you're not going to collect dividends along the way. That's the way margin works. But you believe you can buy my coffee cup back at $50, right? And you just pocketed the $50 differential, right? That's selling short, right? And that's, so it's a little bit different. But we think there's a large chance a lot of what's happened in this recent rally is short squeezes. People who had sold stock short. You always have to do that on margin, by the way. You've sold stock short, right? And all of a sudden the stock price has started to go back up. Now you had to buy. Now I said, I don't like you, Angie Kinzer. Now you have to pay $110 for the coffee cup. And you go, no more Christmas presents for you, right? And but you have to give me the $110, and you got squeezed into coming up with money. That doesn't happen as often in home equity lines of credit as it does inside of the stock world, but that's what happens with the margin squeezes.
Well, one of the risks, like I said, back when I did these kind of loans, it was in the mortgage business, was, what if the rates take a turn? What's the quickest you've ever seen rates go up, like quickly?
Wow, that's not fair on a Monday afternoon.
Well, that wasn't even one of the questions. I just
think
wanted
about
to know.
how quickly. We watch by far, the stock market deal is stocks usually go up on escalators and come down on elevators. Okay. Right? They fall much quicker than they rise.
Okay.
Typically. And that's exactly what we saw happen here. It's what we saw happen in December of 2018. The interest rate itself went down on an elevator. I mean, what we watched happen with the 10-year from going from 1.61 down to literally into the below 0.5 was we've never seen these rates. It was unprecedented, right? Watching the fastest rise, however, is a different story, and it takes a little bit of time. They're more on an escalator, but you do have to pay attention to them. You've got to know what's going on. So,
are those open-ended lines of credit? Are those still deductible?
It only if they're used toward your home. You have to prove that they're able to be used for that. If
Your
not,
primary residence.
yeah, your primary residence. If not, not a chance. 800-928-4001. Angie and I'll take a break. We'll be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
That was kind of delayed there,
I know.
Kinzer. What the heck?
I wanted to change it up a little bit. Sounds like a robot
the
each time.
flair. Yeah, hey, here's the deal. Once upon a time, land far, far away, in our old office here in Anderson, Indiana, I used to have to drive to Purdue to educate people. I taught the seniors at Purdue University in Lafayette in the financial planning program. They had a 4-year degree in financial planning, and I got to teach the capstone course. And I've done this radio show for a little over 22 years, but it was snowy, and it was bitter, brutal snow. And I called my students, texted them actually, and said, hey, here's the deal. I can't make it. Stay home, stay safe, stay warm. And I'm going to do my radio show on Saturday morning for you. And so I did that radio show, and we got more response from you people, you listeners, than we ever had any other time. And so every now and then we try to do that for you, where we do it again, where we provide a case. That's what I did for my Purdue students. And I said, here's the issue, here's the scenario, what would you do? And, so that's what we're going to try to do right now for you and for Angie and for other people that are listening to the show. So we have Fred and Wilma. You may recognize those names. I always liked the Flintstones. Can't help it. We had cars growing up that had, you could see the road as you went by with the rust in the floor. I always thought about sticking my foot down and seeing if I could keep up. Probably a bad idea. Glad I never did it. But, here we are. So we have Fred and Wilma Flintstone. And so the first question was, should they do a Roth conversion? So Fred is 40, Wilma is 35. They've got $100,000 in an IRA, and they've got $20,000 in an emergency fund, and so far their job is not interrupted. Angie.
Oh, no.
Should they do a Roth conversion?
Tell me what they had. You said an IRA.
You should be paying attention. Take notes, right?
Okay.
They have a $100,000 IRA.
Yep.
They have $20,000 in an emergency fund outside of tax, right? And so far, their income has not been disrupted. Should they do a Roth conversion?
Well, the conversions are not, I don't know. You tell me.
The answer is, if nothing else has changed, possibly not, right? Because their income didn't change. They're in the middle of a calamity. Prices are lower, that is true. But when you're looking at a Roth conversion, you're looking at two things. You're looking at doing a conversion when the stock prices are lower because people have been caught in panic selling or problematic selling. And the second thing you're looking at is something changed in your own personal tax environment. They happen to be in a world similar to yours where your income has not been displaced. We've yet to lower your income, though.
Right.
After that answer, I've pondered it.
Well, hey, we got to leave room for you to give
yeah,
the
yeah,
correct
answer. So nothing has really changed in their thing other than the price. So based on their next steps meeting, if they were coming in to do a family update and we were doing their tax planning, if they were below the top of the 12% tax bracket, we would probably still do a conversion because the stock prices were lower, but not because their income had changed. If their income changed, that'd be a whole different thing, right? So what's the second part? The second question we covered.
We talked about stock upgrades or swapping
So they have an account that they inherited from Wilma's grandmother, right?
Mm-hmm.
And it had some stock in it that had a basis of $10,000. It's now worth $1 million, right?
Mm-hmm.
And grandma died, and they've got this $1 million worth of stock, okay? So should they upgrade their stocks?
Yes.
Why?
Because it always benefits the beneficiary. I heard
No,
you
that's
say.
the Roth conversion. The Roth conversion
No.
is always better for the beneficiary, not always better for you. In this case,
Because they can recognize the basis at the time of the death.
they had a step up in basis,
Yes.
is the word. See, I'm going to teach you to be a financial planner yet. You just think you're going to be a marketing person. They had a step up in basis of 100%. So it doesn't matter that Wilma's basis was, or that Wilma's grandmother's basis was $10,000. They get a full step up in basis. So that $1 million is now all tax free. They can sell anything that they want to sell. And so maybe grandma was holding on to a bunch of energy stocks because they did really, really well in the 70s and are getting their behinds handed to them this year, the worst performing sector, if you don't want to count airlines and cruise ships. It's clearly the worst performing sector in the S&P 500 year to date. Oil is getting just clobbered, even with the big deal between Saudi Arabia and Russia and the big OPEC companies today. Still not getting near the support that they ought to. I never thought I would be able to buy gas at $1.54 a gallon again, right? And Wilma's grandmother couldn't sell it because the tax hit would have been too great, which is why you harvest capital losses along the way to give yourself the opportunity to move chess pieces on the table. Remember, when you're in the investment world, you're playing chess with two different groups. You're playing chess with the IRS and you're playing chess with other willing buyers and sellers. And if you're not able to look at both of those boards together, you need to find a fiduciary who is trained in doing that, who can help you, because you've got to have a disciplined process to know how to respond and what takes care of your unique journey, what takes care of the current tax code, not the one from a year ago because it's changed, not the one before the stimulus because it's changed. Not, you've got to find somebody who knows that, and then you've got to find somebody who's willing or capable of saying this is a good buy or a good sell on a particular entity. So when you look at all of that, you can upgrade your stocks and make those decisions.
So we're to home equity lines of credit.
To a home, well, no, don't we still have the capital loss harvesting? Because here's the deal: stocks move up and down every day.
Yeah.
Right. So I've had people say, why would I want to harvest a loss if I have no gain? Well, one, you can still take $3,000 off your tax return, and two, you're saving up those losses. I mean, it's we played bingo on Zoom the other day. We had 25 of the 29 of us on a Zoom call, and we were playing bingo at lunchtime. And it would be nice to be able to save numbers that you didn't need on this card for a future card.
Right.
That's kind of how capital loss works. You can use it today, but sometimes you're doing it because you want to use it on a different card. You want to use it on a different stock, a different day, a different sale, a different tax year. You can carry a capital loss forward, for indefinitely. There's no reason not to use it and not to be smart about it. So when that portfolio came, even though we had a full step up in basis the day that it arrived, a month later, 6 weeks later, 2 months later, there could be losses, especially if it happened this year, right? If you inherited something in February, you could have a 20% loss today, right? Harvest some losses, do some upgrades, get smart about it. Now, do you need a home equity line of credit if you're Fred and Wilma and you've got $1 million you just inherited and a $100,000 IRA and $20,000 emergency fund? The answer is no. You don't need to do that. Never take more risk than you need in the world. So I will try to find some other cartoon characters that I can use going forward. I like Fred and Wilma. Maybe
what about
next
Barney
time
and Betty Rubble?
And next time maybe it will be those two. Hey, you're listening to Consider This Program. Give us a call, 800-928-4001. We'll take a break and be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Well, good morning and welcome to Consider This program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
We hope you enjoyed today's program. We're going to finish this up with things that go bump in the night. Is that what you said, Angie?
No.
Oh, it's not Halloween?
I found
It feels like Halloween.
You know, I'm always reading these blogs because I always try to look in the top 100, which our own Andrew Thrasher is like number 36, by the way. But anyway.
That's the financial bloggers in the country.
Financial bloggers in the country. But some of them have some, where I get my little surveys from. And this one was called Things That Make You Go, And so it's just little random, like, financial questions. And I thought, I'm going to bring a couple of these in.
So are some of these going to wind up on our financial tidbits page? So if you don't know, the Financial Enhancement Group has a page on Facebook. But we have a group on financial tidbits that you can apply to be a part of. It's designed for our radio listeners. We have almost 1,000 people.
Yep. And
you may very well find some of these there.
Okay. Well, here's a question. Why is credit card debt at an all-time high while unemployment is at a 50-year low?
Part of that is that the interest rate is lower. Part of that is it's bad math. So years and years and years ago, when we were just wee tots, Angie and I are the same age, so I'll tell you how old I am.
He's a month older.
I can't tell you how old she is. So the first credit card was actually the second credit card was the Playboy card.
Oh, okay.
And people who had after that, they came out with the credit cards, the Visa, the MasterCard. People who had credit card debt at that point in time were people who couldn't pay their monthly bills. So they were spending more than they made. Okay? And so they came up with the math to figure out what credit card indebtedness was. And the way they did it is they took your debt divided by 30 days, and that's what got reported in terms of what the government got as credit card debt, right? Now, I use my plastic more than anybody you've ever met, right? Because it, one, pays for all my airplane flights, right? So personally, I use my credit card for everything. And the company uses credit cards for all of our events, all of the lectures, and everything we do. Now, do you suppose that we paid anything in interest last year? No, you know me better than that, right? So one day a month, our credit card balance is zero. Other than that, it's pretty high, right? So it's,
Yeah, so you can get bad numbers.
You hear the expression fake news, this is bad math.
Right.
Right?
Well, and there are some legit people that don't
Sure.
do not have an income high enough that they might supplement.
Absolutely. Those people are out there.
Yeah.
But the balance that I carry, most of the month is a whole lot more than what most of those people who can't pay their bills, have that's on there. It's bad. It truly is bad math to a large degree.
Well, we may have to wait on any more questions because I know that
you got one that really
deep
you
thoughts.
poked the pig, right? I had to answer that question, and you're right. We're running out of time. Call Angie, 800-928-4001. Get signed up for a Next Steps meeting. We will give you in 90 minutes things you need to consider today, things you're going to want to consider in your future, and more importantly, if we choose to partner together, what you need to consider. Have an outstanding week, folks. 800-928-4001. We'll see you again next time.
You You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to yourlifeafterwork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own and they were in the same situation. Call 800